Hi everyone, welcome to another episode of the Patient World channel. Friday 10th of October was an early warning sign for all of us as the market dipped and many panicked. In this episode we are going to answer the ultimate question. Are we in an AI bubble and is the stock market about to crash? I'll show you what the experts say, what data says, provide my own opinion, and talk about a framework that I think turns the next stock market crash to a once-in-a-lifetime wealth opportunity. If you are new here, my name is Tasos. I am a CFA charter holder, and on this channel I share my investing and personal finance journey transparently every single week. I plan to share the good and the bad as I plan to grow this portfolio to 6 figures and beyond. Like this video to help us reach as many people as possible and subscribe to the channel. Thank you to all 100 subscribers and the support to date. It is greatly appreciated, and as always, please do your own research before making any financial decisions. Right, let's jump straight into the video with a portfolio update. The portfolio sits at £12,680, a return of £875 or 7.42%, and the allocation is 31% in Google, 30.5% in Amazon, 17% in SPGI, 11.7% in Adobe, and the remaining allocation is in FICO. As you can see, the majority of gains come from Google with a return of 34%, followed by Fair Isaac with a marginal 7.6%, and the other three allocations are currently in red. Overall, I feel very comfortable owning these businesses as they are high quality businesses that I expect to compound well into the future, and I plan to hold them for the long term. So the ultimate question these days is if the stock market is in a bubble and when is the next stock market crash. I am sure you've seen this chart before, but we have here the stages in bubble, including the stealth phase, awareness phase, mania phase, and blow-off phase. As you'll see, initially there is a takeoff, there is a small sell-off, a bear trap, then we have media attention, enthusiasm, greed as stock prices continue to rise. We peak at the new paradigm, and then as stock prices come down, we have the denial, then we have the bull trap and the narrative of returning to normal, and then fear, capitulation, where everybody is selling as stock market is going down, despair, and then returning to the mean. If you are able to forecast accurately where we are on this curve, you stand to make a lot of money. However, even experts are not able to forecast this accurately enough. Okay, let's look at what the experts say and what data shows. Oaktree's Howard Marks says AI frenzy isn't a bubble, at least not yet. And he quoted, "My response to date has been that the valuations are high but not crazy. Expensive and going down tomorrow are not synonymous. And to me, the main ingredient in bubbles is psychological excess, some kind of temporary mania. For a company in this sector or industry, there is no such thing as price too high. And I don't detect that level of mania at this time, so I have not put the bubble label on this incident. It just hasn't reached that critical mass of mania." So Howard Mark, a legendary investor, says we are not in a bubble, not yet. We have Ken Griffin, the Citadel founder and CEO. He cautioned that America's market rally is being propped up by policies better suited to a recession than a growing economy. Speaking in New York, he said fiscal and monetary policies have created a sugar high that masks underlying risks like inflation and dollar weakness. Despite booming equities, Griffin pointed to gold's record surge up more than 50% this year as evidence investors are quietly hedging against US sovereign risk. Griffin isn't going to ignore the distress signal, he said during the conference. Inflation is substantially above target and substantially above target for all forecasts next year. It's part of the reason the dollar depreciated. Gold is at record highs and the appreciation on the dollar substitutes is unbelievable. So we are seeing substantial asset inflation away from the dollar as people are looking for ways to effectively de-dollarize or de-risk their portfolios vis-a-vis US sovereign risk. Next up, we have the CEO of JP Morgan, Jamie Dimon. Jamie Dimon sees stocks in some form of bubble territory. Dimon compared today's AI exuberance to the early days of the internet. He said he was somewhat cautious about conditions in the current market, yet he urged people not to simply label all of AI as speculative frenzy. You can't look at AI as a bubble, though some of these things may be in the bubble already. In total, it will probably pay off. Days earlier, Dimon had warned that he saw a 30% chance of a correction in the stock market, calling himself far more worried than others. So basically, the CEO of JP Morgan has a 30% chance of a correction in the stock market, which I think is not priced in today. And let's look at Dan Ives' comments, Wedbush Securities Managing Director, where he reportedly brushed aside concerns of an AI bubble, days after OpenAI co-founder and CEO warned about one forming right now. Ives advised investors to remain focused and not get too nervous following the recent correction in technology stocks, adding that there will be phases when stocks decline. He also pointed out that there will be certain AI winners and losers. Over the next 12 months, he sees an AI-driven market rally that could boost tech stocks by 20 to 25%. And lastly, let's look at what Tom Lee thinks. FundStrat's Tom Lee says the US market's strength isn't a sign of speculative excess but a reflection of powerful structural tailwinds led by AI and one more catalyst. In a new CNBC interview, he pushed back on bubble fears, arguing that investors are underestimating how much the twin forces of AI and blockchain are reshaping both corporate strategy and capital flows. At a time when the US is dominating AI, and of course now we have this big tailwind as blockchain is an initiative that Wall Street is building products on. So I think there are a lot of reasons for investors to stay optimistic. And I know there is a lot of talk about bubbles, but I think the thing I would just continue to point out is Nvidia trades at around 27 times of forward earnings. It's still on a price to earnings basis cheaper than Walmart and Costco, which traded around 47 and 34 times forward earnings respectively. So from experts, we have a mixed view. We have Dan Ives and Tom Lee, which are more bullish than the rest of them, saying that AI is not a bubble and the stock market will continue to climb. On the other hand, we have Ken Griffin and Jamie Dimon being more cautious and identifying more risks in the current market. Ken Griffin sees the gold price surge as a worrying factor, and Jamie Dimon allocates a 30% probability of a stock market crash. What does the data tell us? The current S&P 500 P ratio sits at around 29.7 times. It's historically above average but below the dot-com bubble. The Buffett indicator, which is the total value of all publicly traded stocks divided by the GDP ratio, it's well above the dot-com bubble at 219% compared to the dot-com peak of 138%. And lastly, the Max 7 total market cap as a percentage share of the S&P 500 sits at an all-time high at around 35%. So we have a big concentration in the Max 7 propping up the S&P 500. What are my opinions and thoughts on this? Firstly, the data suggests we are trading at historically elevated valuations. Secondly, it is clear that finding good deals in the current market is becoming harder every single day. And lastly, there are pockets of the stock market that are already in bubble territories, in my opinion. And there are many examples of these pockets that are in a bubble territory, but let's look at a couple of examples. Firstly, let's take a look at Palantir Technologies, ticker symbol PLTR. This is a retail investor favorite. The year-to-date return is 140%. The 5-year return is 1,759%. The trailing PE is 599 times. And the forward PE is 242 times. On a price to sales multiple, we see something very similar and extremely high valuations. The trailing price to sales multiple is 124 times and the forward price to sales multiple is 89 times. I'm sure Palantir is a great company and offer a great product. However, these price multiples are too high and I'm certainly not investing at the current levels. Next up, let's look at another example, which I think demonstrates that some pockets of the market are in bubble territory. Company Oklo, ticker symbol OKLO. This company essentially designs and develops fission power plants to provide reliable and commercial scale energy to customers in the United States. It provides used nuclear fuel recycling services and was founded in 2013 and is based in California. The market cap is $19.8 billion and the year-to-date return is 699.5%. You would think that this company generates massive amounts of profits, but that's not the case. This company is not generating any revenue. So we have a company that returned 699.5% this year. Its market cap is $19.8 billion, but generates $0 in revenue. To me, this is the perfect example of a bubble. I don't think this is sustainable. So when things turn sour, Oklo stock will suffer. So to summarize, the stock market is trading at elevated price multiples. The experts have a mixed view. And I personally think that we already have pockets in the stock market that are trading in bubble territories. And to be clear, I don't think that the overall market is at the capitulation stage where everybody is rushing to buy. And there is a good summary from Howard Mark on one of the memos he published back in the January 2000 around the dot-com bubble. And my capitulation comment is that I don't think we're in stage 2 yet. So let's just go over these 5 lessons from Howard Mark. The positives behind stocks can be genuine and still produce losses if you overpay for them. I think this condition already exists in the market, and as I shared, I think Palantir and Oklo are 2 examples that fall into this category. Those positives and the massive profits that seemingly everyone else is enjoying can eventually cause those who have resisted participating to capitulate. I think we are not there yet. I think a lot of investors are skeptical about some of the stocks, hence we are not in the capitulation stage. A top in a stock, group or market occurs when the last holdout who will become a buyer does so. The timing is often unrelated to fundamental developments. In other words, we don't know when the top will be in. This rally can last for many more years. Lesson number 4. Prices are too high is far from synonymous with the next move will be downward. Things can be overpriced and stay that way for a long time or become far more so. The way I translate this is essentially, even though the market is trading at historically elevated price to earnings multiple, this elevated characteristic can remain and even expand over time. And lesson number 5, eventually though, valuation has to matter. Due to the psychology of the markets, eventually the market will return to an average or mean price multiple area. So, what are my concerns today? Firstly, we have our over-concentration of the S&P 500 as the Max 7 now account for 35% of the S&P 500. These are great companies today, but it's very hard to remain great for a long period of time. Again, looking at one of Oaktree's memos, we can see that at the beginning of the 2000s, these 20 companies were the most heavily represented in the index. This is the group of companies here. We have Microsoft, General Electric, Cisco, Walmart, Merck, Coca-Cola, Procter & Gamble, AIG, Citigroup, IBM, Oracle, Verizon, Pfizer, Qualcomm, Johnson & Johnson, and so on and so forth. However, at the beginning of 2024, only 6 out of these 20 companies were still in the top 20. These are Microsoft, Walmart, ExxonMobil, Johnson & Johnson, Procter & Gamble, and Home Depot. Even though today we have these Max 7 companies that the majority of them, I consider them to be highly profitable, high quality companies generating a lot of free cash flow, it's not necessarily the case that they will remain the Max 7 companies going forward. In today's Magnificent 7, only Microsoft was in the top 20 24 years ago. So the Max 7 group will change, but we have investors piling money into these companies. In bubbles, investors treat the leading companies and pay for their stocks as though the firms are sure to remain leaders for decades. Some do and some don't, but change seems to be the rule than persistence. So I think the message here is we need to remain diversified and disciplined. An additional concern I have is, given the elevated price multiples that the stock market currently trades in, it's easier for any factor to tip the market into correction territory. One of those factors that I'm currently keeping an eye on, and the longer it gets, the more likely it will cause a correction, is the US government shutdown. The shutdown is currently ongoing for more than 2 weeks now. People are not paid and are getting fired. This is the real economy, and I expect to have real implications if people are not being paid, because a few issues come up. How are they going to be paying their rents, their mortgages, spending money out to restaurants, buying stuff online, traveling, etc. The longer this goes on, the higher the risk this becomes. Let's look at some stats provided by the White House. For Texas, the gross state product impact is a decline of 1.4 billion each week, or 6.3 billion per month. The increase in unemployment was about 4,100 workers, and the federal workers affected is around 218,000 people. Some of them were furloughed and some of them are working without pay. In California, we have the gross state product impact declining by 2.1 billion each week, or the equivalent of 9.2 billion per month. Increase in unemployment was 5,100 people. And how many federal workers were affected? It's around 251,000 people, with 1.4% of state workforce furloughed or working without pay. And consumer spending decline from lost wages is around $3.2 billion. The US shutdown is leading to people getting fired or not being paid, which essentially impacts the real economy. people are not going to spend as much money. This will end up showing in the businesses that are part of the stock market. The longer this government shutdown lasts, the greater the risk is that the stock market will enter a correction. Am I saying an imminent crash is coming? No. Eventually, are we going to have one? Yes. Am I planning to divest? No. Instead, I will share what my thought process is and a framework which I think turns the next crash in a wealth generation opportunity later on in this video. Before I get to that, let's look at the summary from the Oak Tree Capital memo. The cautionary signs today include the following: the optimism that has prevailed in the market since late 2022, the above average valuation on the S&P 500, and the fact that its stocks in most industrial groups sell at higher multiples than stocks in those industries in the rest of the world, the enthusiasm that is being applied to the new thing of AI and perhaps the extension of that positive psychology to other high-tech areas, the implicit presumption that the top 7 companies will continue to be successful, the possibility that some of the appreciation of the S&P 500 has stemmed from automated buying of these stocks by index investors without regard for their intrinsic value. Although not directly related to stocks, I have to mention Bitcoin. Regardless of its merit, the fact that its price rose 465% in the last 2 years does suggest an overabundance of caution. And on the last day of 2024, Howard Marks received this chart here, which fits these cautionary signs that he was talking about. We have the S&P 500 forward PE ratios and subsequent 10-year returns. The current forward PE of the S&P 500 is around 22 to 24 times, and as we can see from this chart, history suggests if the S&P 500 is trading at the current forward PE levels, the next 10-year returns will be below zero. And I have to say, a warning shot has been fired by the market on Friday the 10th of October. On the 10th of October, the S&P 500 declined by 2.8%, and the sell-off came from Trump posting on Truth Social. Trump said that China was becoming very hostile with the rest of the world, especially when it comes to its control of rare earth metals. He accused China of holding the world captive because of its monopoly on these crucial resources, and the key part that the stock market reacted to in the 500-word Trump post was the following. One of the policies that we are calculating at this moment is a massive increase of tariffs on Chinese products coming into the United States of America. And as a result, $2 trillion disappeared from the market and a lot of people panicked. When I looked at the one-day S&P 500 map, I considered this to be a small dip. We had Nvidia dropping by 4.9%, Microsoft 2.2%, Broadcom by 5.9%, Apple by 3.5%, Amazon, which I held at the time, by 5%, Google by 2%, more volatile stocks with AMD dropping by 7.7%, Qualcomm by 7.3%, Hood by 8.9%, so on and so forth. People panicked, and meanwhile, the 1 week performance looked like this. It's literally a small dip. Nvidia was down 2.4%, Microsoft was down by 1%, Apple was down by 4.9%, Amazon down by 1.4%, Google down by 3.6%, and you also had companies that were in the green, including Netflix at 5.8%, AMD at 30.5%, Palantir at 1.4%, Oracle at 2.4%, and so on and so forth. When you zoom out further, year-to-date return of the S&P 500 was 13.9%, 1 year 14.4%, and 5 year 91.9%. So before I jump on my framework, a few questions that I will be asking to you. So the first question to you is, are you invested and are you ready for this? If there is a stock correction, you should expect real and high volatility. On this table, we can see the percentage change from the 2000 highs to the 14th of April of 2000s for these companies here. And you'll see a decline of 50% or more is kind of the normal. The average is 61% decline. Amazon, for example, declined by 48%. So the 5% decline we've seen in Amazon stock on the 10th of October is nowhere near the 48% decline that we've seen during the dot-com bubble. I'm not saying we are going to see another 48% decline, but if there is a stock market correction, you bet we are going to see much more declines in a lot of stocks, so you need to be ready for it. The second question is, what did you do? Did you panic? I personally did not buy or sell any of my stocks. So if you are not ready for volatility, or if you panicked during the 10th of October sell-off, I think the framework that I'm going to talk about will not only help you survive, not panic, but will also help you make a lot of money. So my framework to help me deal with volatility and capitalize on a stock market correction is as follows and is split in 4 areas. Firstly, understand what you own. Secondly, understand why you own those companies. Third, try to focus on data. Try to remove the emotion. And lastly, have a plan. Let me walk you through these 4 pillars with some examples. As I showed at the beginning of the video, my investment portfolio includes 5 companies: Google, Amazon, S&P Global, Adobe, and Fair Isaac. I've done my research, I understand what these businesses are doing, and for example, if I see Amazon stock trading 50% lower than what it's trading today, I will definitely buying, as I think the stock price will double in the next 5 years. Number 2 is understand why you own these businesses. My view on all these 5 companies, it's very simple. For me, Google has exceptional assets and in my opinion is one of the companies that is leading in this new AI era. It has great distribution as millions and millions of people are using their platforms. They lead on AI models with Gemini. They have a great AI team with DeepMind. Has TPUs, which will be a great advantage when it comes to inference and costs. Have a wide ecosystem layering on top subscription services. On YouTube, which is the leader in streaming. And the Waymo, which is the leader in robotaxi. So I expect over the coming years for Google to continue to grow and further establish themselves as one of the AI winners. We have Amazon. Amazon underperformed its peer in this market because of the capital expenditures that they are currently doing, leaning into growth opportunities. High margin businesses such as AWS, subscriptions, ad, and third-party sellers are growing much faster than the low margin businesses, which means over time higher price multiples and predictability for the company. They have these additional projects which I expect to re-accelerate growth in their core businesses but also provide incremental additional cash flows, which include Project Kuiper. They are offering to provide internet from space. Pharmacy, they are capturing more and more market share in pharmacy, which is a huge market. And Zoox, which is the robotaxi service, and I expect it will help them enhance their margins when it comes to online stores and deliveries. We have S&P Global, combination of businesses that are expected to grow as data and markets grow. If you invest in the S&P 500, S&P Global is taking a fee out of that, but also their rating business is a high margin business that eventually should see an uptick when companies go and issue or refinance their debt. Adobe is currently suffering from the market narrative that AI is killing their business. I think the opposite is true. AI is enhancing their business. As management noted that AI layering leads to more engagement and less churn. And lastly, we have Fair Isaac, ticker symbol FICO, which I expect to benefit when mortgage rates come down as a result of yields coming down over time. So number 1 and 2 is understand what you own and why you own them. This essentially helps you enhance your understanding of these businesses and makes you more likely to hold on to them if the stock price declines. Number 3 is try to focus on data. Remove emotion. The stock price reflects the voting of the market, but longer term fundamentals are much more important. If you tracked only the stock price of this company, you would think that the business is in trouble. The company went from around $550 to now $330, which is a decline of 41%. However, at the same time, fundamentals kept rising. You can see free cash flow went from $14.4 to $22.2. This stock is Adobe, as I mentioned earlier. I think the market narrative is wrong. Fundamentals seem to be absolutely fine at this point in time, and I expect the stock price to re-rate once the market narrative changes. So focusing on hard data removes emotion, which will help you make better financial decisions. And lastly, number 4 is have a plan. I'm talking about outside the market, but also in the market. So let me split this out quickly. If you followed me from the beginning, you'd know that back in December 24, I divested all of my investments in this portfolio. It was around £45,000 back then, and that amount of money went straight into cash holdings. This amount of money plus an additional amount held in a separate account are earmarked for paying down our mortgage. So over the last years, we are focused on paying down all of our debt in order to make us much more comfortable investing in the stock market for the longer term and to avoid putting money in and after a few months selling everything to pay a loan or a purchase of some sort. I now feel much more comfortable for a market correction as some of this money can be deployed if there is a stock market correction, as I see stock declines as opportunities to purchase high quality businesses at lower prices. So what is the market plan? I continue to research so I can identify high quality businesses. If the opportunities arise, I want to buy these high quality businesses as I build the conviction that they will continue to compound well into the future. I'm happy to stay on the sidelines if I've missed the train, and I want to invest in fair to undervalued businesses. And if the opportunities arise, for example, if we have a market correction, I will be deploying cash. You are wondering, why am I even talking about this? I want you and me to make money. I want us to turn the next crash to a generational wealth opportunity. I'll leave you with a positive. Crashes or corrections is where serious money is being made. And I'll give you an example of my past experience. Back in September 2021, I started buying Meta platforms. My first buy was at a price of $379.68. As you can see here, over time I kept buying, and in November 2022 was my last buy at a price of $112.49. During this period, the stock price fell by over 70%, but because I had high conviction, I kept buying the stock. As a result, I made a lot of gains. I sold in May 2023 12 stocks at a gain of £715 and subsequently sold the remaining 13 stocks at a gain of £4,724. What I essentially was doing back then is apply the same framework that I talked about today. It's a simple framework that allowed me to buy as the company dropped by over 70% and helped me make £5,500 as a result of this one trade. That's it for this episode. Like the video, subscribe to the channel, and I'll see you in the next one.